there, my name's Alex Wyatt and I am the Head of Business Development at simplyvat.com. We provide international VAT services and I'm here today to talk to you through what you might be able to use for your businesses that you work with as e-commerce advisors. So there's a lot to think about when selling abroad, as I'm sure you know from working with e-commerce. There's obvious language differences and not so obvious cultural nuances, such as cultural differences in payment methods. For example, the Germans like bank transfers, whereas the UK, we much prefer our PayPal accounts. And then, of course, there's the rules and regulations surrounding international VAT. We find people don't know they have an international VAT obligation, or indeed they don't want to know. So the usual response we get is head down in the sand approach, which can work for some time, but as we've seen with the different tax authorities cracking down on online sellers, it's not a permanent, sustainable solution for businesses. So what actually are the different rules and regulations surrounding international VAT? So what you need to ask your businesses that you work with is, what am I selling? Are they goods or services? Who am I selling to? Businesses or consumers? And where are they? Are they within the EU or outside of the EU? So during this presentation, I will touch upon with a high-level view of each of the scenarios detailed above. So firstly, we will look at selling services to businesses within the EU. The supply of services is covered by the general rule. So if both companies are VAT registered, the services would be taxable where the customer is. The seller obtains a valid VAT number from the customer and applies this to the invoice with the obligatory phrase containing the words "customer accounts for the VAT under the reverse charge." So the seller also must complete an EC sales list during their UK VAT return. And the customer accounts for the VAT as both input and output on their VAT return. If the supplier is not VAT registered, it is not VATable as a transaction, and it doesn't need to be recorded anywhere. And there are, of course, exceptions to the rules. Namely, you may need to register an account for local VAT in the country of supply when it comes to landed related services, events and conferences, and transport. For example, land-related services are taxed where the land is. Admission to educational events is taxed where the event is taking place. So you need to work out the specifics on how to treat the services you're applying. Business-to-customer supplies are, in general, subject to VAT in the country where the supplier has its place of establishment. There are special rules, for example, services relating to the immovable property, cultural, artistic, and sporting activities. So this differs from when supplying e-services to private customers. If you're selling broadcasting, telecommunications, and electronic services to consumers, the new rules were introduced at the start of January 2015. And it's a fundamental change. So instead of VAT being accounted for where the supplier is, the VAT will be charged where the consumer resides. So you as the supplier need to collate all the relevant information on where your customer is, as well as know which VAT rate applies to your particular service. This information needs to be given to the relevant tax authorities, and any VAT owed will need to be paid over. So there are two ways of doing this. You can register for local VAT where your customers are, or through MOS, which is the mini one-stop shop. So VAT MOS is designed to apparently make the process easier. You will need to register through one member state, so for example, HMRC, and this registration will allow you to submit the VAT data through that one specific tax authority, who will in turn distribute the information and payments to the other tax authorities where your customers are. So please remember, this only applies to e-services and not to the sale of goods to private customers. There are plans to introduce a VAT MOS for the sale of goods in 2021, but this is still up for debate. So now we're moving on to looking at selling goods in Europe. Firstly, we'll look at selling to other EU businesses. So there's no obligation for you, the supplier, to VAT register in another EU country if your customer is VAT registered business with a valid VAT number, which you can check on buys, and you show the valid VAT number on the invoice along with the obligatory phrase intra-EU dispatch of goods, customer liable to account for the VAT. So you will retain this proof of the goods that have left the UK and went to another EU customer. However, there is some extra paperwork involved that needs to be completed, namely on your VAT return, an additional EC sales list, and if you've exceeded the Intrastat thresholds and Intrastat filing. The UK VAT return, it will be reported in box 8 as a movement of goods to another EU member state, and in box 6 in total sales. EC sales list, this will be reported on a periodic list as a movement of goods to another VAT number that's not a GB VAT number. An Intrastat is a supplementary report detailing the goods moved from the UK to other EU member states. This is only required when thresholds of dispatches and acquisitions are reached. Dispatches and acquisitions are VAT speak for EU imports and exports. So in VAT speak, the terms of import and export relate only to the movement of goods between EU and the rest of the world. As there's free trade within the EU, there are no, with that, there's no customs clearance. Transactions between EU member states are referred to as acquisitions and dispatches. So if you're selling goods to private consumers online in Europe, you're governed by the distance selling rules. And I think these rules really help small businesses expand throughout Europe through their online selling journey. So those rules apply even if you're not a VAT registered business in the UK, and even if you're a sole trader. They also apply if you're using the marketplaces such as eBay and Amazon to sell to customers. But it's important to be fully aware that eBay and Amazon don't take responsibility for the VAT of the seller at all. So what exactly are these distance selling rules? The rules state that VAT should be locally charged until VAT registration thresholds set by each EU tax authority are exceeded in that specific country within a calendar year. So in most EU countries, the threshold is set at 35,000 euros or the currency equivalent. And the only other countries where it differs is namely in Germany, Netherlands, and Luxembourg, where it's 100,000 euros. So to put it into perspective, if a business is selling medium to high value goods such as electronics or designer goods, it doesn't take very much to breach the smaller thresholds of 35,000 euros. So it is really important to make sure that you're analyzing how much you're selling cross-border. So here's an example to see exactly what happens. So let's say we're selling mobile phone covers to Hungary. To start with, your sales are just getting going and you're below the Hungarian threshold of Florence, 35,000 euros. At this point, you'll charge UK VAT, unless you're not VAT registered in the UK, and in this case, no UK VAT is charged prior to the Hungarian threshold being reached. As you approach the Hungarian threshold and you know your sales will continue to rise, you will need to register for Hungarian VAT. So once your sales turnover exceeds the threshold, you'll then begin to apply the standard rate of 27%, or a reduced rate if that's applicable to your products. Once registered, you will also have to file periodic VAT returns, which in Hungary is monthly. And you'll stay registered as long as the distance selling, you can continue your distance sales and they exceed the threshold every year. If your sales drop off and you want to deregister, you'll have to check the rules depending on how soon you can deregister, but you will be able to. And it's important to know that you can't go under the radar. So if you exceed a threshold and fail to register, you may be hit with significant penalties and interest payments. So penalties can go up to 120% in Italy, for example. And there's a big spotlight on non-compliant sellers currently throughout the EU, and especially by the German and UK tax authorities. The UK alone reported losses of £1.5 billion per year, and throughout the EU, it is calculated that €160 billion is lost from underdeclared VAT. So to stop this hemorrhaging, and special measures have been put into place across the EU. And they've set up the mutual cooperation where they have special units focused on e-commerce, and they also share data between the different tax authorities. So also the tax authorities, mainly the UK HMRC, the German tax authorities, and the French are ordering Amazon shops to be shut down and suspended until the tax authorities are satisfied that the seller is compliant. Online retailers selling abroad need to be very aware of their tax obligations in the countries where their customers are, because it can become business critical to be compliant, and unfortunately, ignorance is no defense. So there's a few things to think about when selling cross-border. So firstly, it's important to make sure that you have systems in place to capture accurate sales information, including which countries your customers are. Also, make sure you include shipping and delivery costs, as these are included in the final sums to see if the threshold has been exceeded. And with this in mind, also make sure you add VAT to the shipping costs, as well as this is included in your product prices on your invoices. It's important to keep up to date with the VAT registration thresholds as well. They don't change too regularly, but if they do, this can really impact how much you're selling and when you need to VAT register. Also, again, it's important to know what VAT rates apply to your goods or services. Don't make the assumption that because your goods have a certain VAT rate here in the UK, that it will be the same elsewhere. So for example, children's clothing in the UK and Ireland, it is 0 rated, but everywhere else it attracts the standard VAT rate for the most part. So it's really important to make sure that if you're crossing over, your margins can account for the variations. Once registered elsewhere, for example, Hungary, do not charge the UK VAT, as well as the Hungarian VAT on those sales. So VAT can only be accounted in one country. So just make sure you're including the right country's VAT rate. And now we're going to talk to you a little bit about pricing, because it's good to plan up front. So when you're setting your pricing, work out if one price fits all. So since the VAT rates vary from across the UK from 17% to 27%, can the margins that you've set for your products absorb the variations when selling to different EU countries? So it's always a good idea to do some market research in your chosen markets to find out how the businesses you're working with compare to local suppliers and how much leeway this may give. So once a business starts the process to register for VAT, it can take approximately 4 to 10 weeks to obtain a VAT registration, depending on the country that you're registering in. In France, it's taking closer to 10 weeks, for example, so it's really important to make sure you're applying ahead of time. There are differing frequency of VAT returns depending on the country of registration. So in the UK here we have quarterly filing, but in Germany you have monthly filing with an additional annual VAT return. Different deadlines to submit returns and pay the VAT owed as well. So in the UK, we're paying quarterly. In Germany, you have 10 days to pay your VAT and file your VAT returns. So it's quite a quick turnover. So when sales are doing really well, you also need to start thinking about filing intrastat reports, which are statutory statistical returns used to record the movement of goods within the EU. So different countries have, again, different intrastat thresholds for arrivals and dispatches, which are EU terms for intercommunity imports and exports. So one area where there's a lot of confusion or lack of knowledge and information about VAT compliance issues is when using fulfillment centers across the EU. So if you're thinking about using or already use a fulfillment center that are now available in Europe, such as the Amazon FBA, you should be aware that the movement of goods within the EU triggers an immediate need to VAT register in that country as the stock becomes a taxable supply. So as a non-resident, there are no thresholds to exceed. The fulfillment center usually does not take ownership of the goods, but be sure to check the contract with them, as this may vary. A real-life example of this, someone we knew about 3 years ago was persuaded to put his goods in a fulfillment center in Germany, only to be approached about 18 months later from the German tax authorities with a back bill of 30,000 euros, which he had to settle. So the consequences of non-compliance are very real. So the HMRC has recently put in the Fulfillment Due Diligence Scheme in an attempt to make headway on non-compliant sellers here in the UK. So the fulfillment houses have to register onto the scheme. They are responsible for auditing whether the customers using the fulfillment houses are VAT compliant. If not, it is the fulfillment house's obligation to try and make them so, and also inform HMRC. So records have to be kept, and failure to subscribe to the scheme or keep records will result in penalties. So fulfillment centers have to subscribe from the 1st of April this year, and the official work processes will be implemented a year later in April 2019. So now we're moving on to the selling of goods outside the EU. Generally speaking, you can zero rate supplies exported outside the European Union, provided that you follow strict rules. So for goods, you have to provide evidence of export to show that the goods have left the EU. You do, however, need to get information on the local tax rules and regulations in the countries you're importing into, because you may have obligations there, including import charges, and take into consideration which would affect your margins. For B2B services, that is usually accounted for where the customer is based, therefore outside the scope of UK VAT, unless the use and enjoyment rule applies. Certain services such as hire of movable goods, for example, if a car is driven from a Spanish private individual, breaks down in France, and is repaired locally, French VAT has to be charged to the Spanish individual, and B2B services to non-EU customers. If used and enjoyed in the UK, then the place of supply would be the UK. Therefore, the UK VAT is due on the service. B2C services are to non-EU customers should attract VAT on the country of establishment of the supplier. However, certain B2C services supplied to non-EU customers are taxed where the customer is based, therefore outside the scope of UK VAT, such services as advertising, consultants, lawyers, accountants, and financials. I think I need to skip one, sorry. For B2B services, VAT is usually accounted for where the customer is based, therefore outside the scope of UK VAT, unless, oh, sorry, actually I just went through that. So I'm going to talk about the potential effect of Brexit on the VAT obligations once we leave the single market and customs union, which apparently we will be doing definitely according to the government's announcements recently. So currently, as we've seen now, there is free trade and there is no obligation to VAT register and just the completion of reporting requirements, so the EU governments can cross-check filings and intra-community. There's also the opportunity to access simplification, such as triangulation, which mitigates any intra-community VAT registration liabilities. Once we're outside the EU, any transactions to customers in other EU member states will become imports or exports. The great news is that there will no longer be a need for EC sales lists and intrastat declarations. However, these will be replaced with import and export and customs documents. So you'll no longer be able to apply the simplification measures. Any exports you make to the EU business customers will be zero rated, and you won't have to charge UK VAT on those exports. However, your EU customers will have to pay import charges on the goods you are sending to them. So on the other hand, if you import from EU suppliers, you will now have to pay import charges on those supplies. The VAT element you will need to reclaim on your local VAT return. However, this will have cash flow implications for you, as you will have to wait until the VAT return is filed to receive the reclaim. You'll also probably have to use a freight forwarder or customs broker in order to get your goods cleared. And you also, as a UK-based business outside of the EU, may have to appoint a fiscal representative in some EU countries to cover the liability of VAT. So just to recap the services, VAT on B2B supply of services comes under the reverse charge mechanism. The EC sales lists have to be completed, and sales to non-EU buyers are charged outside the scope of UK VAT. After Brexit, as with now, if you, as a UK business supplying services to, for example, a USA customer, the VAT is outside the scope of VAT, and therefore it just gets reported in box 6 of the UK VAT return. You don't have to apply any reverse charge, and you don't have to worry about any EC sales lists. Now, after Brexit, as with now, the customer accounts for the VAT wherever they are, and we think this will stay the same. Post-Brexit, as a non-EU company receiving services from an EU supplier, in theory, you will receive an invoice without VAT, and the value should be reported in your UK VAT return in box 7. The income from VAT on online sales is a great revenue earner for UK tax. The UK government may look to protect this income by legislating for some special rules when UK companies sell to EU citizens. All things being equal, though after Brexit, goods from the UK will now be imported to the EU private customers. Import charges will now be applied to those goods as we've lost the free movement. So one of two things can happen. Either the customer accounts for the VAT, the import VAT, so just before the goods get delivered, the customer will receive an email from, say, DHL asking for the customer to pay the import taxes and duties. This is not the best customer experience and can result in a large number of goods being returned to the seller. Alternatively, the seller can VAT register in each country where your customers are. Or another option would be to use a warehouse or fulfillment within one of the EU countries to have access to the single market and import the goods there, which will then be leveraging the EU VAT distance selling rules. Already there is an impact on your cash flow because of import charges and the possible use of local EU warehouses and fiscal representatives that may apply. For B2C services, currently non-digital services to private consumers are now accounted for where the supplier is based. For the supplier, under the new rules, it will be how a new VAT Act will consider B2C sales to non-UK consumers. It's hard to tell the movement. If you're selling digital services to EU private consumers, you will have to apply for a non-union VAT-MOS registration because after Brexit, as a UK seller, you will have no access to VAT-MOS system via the UK. You will have to choose a member state to register for VAT-MOS in, and you may need a local VAT-MOS agent depending on the rules for the relevant country. So to summarize, it really is useful to do your homework when you're thinking about trade internationally or when you're helping businesses trade internationally. You need to understand that there is a cost of VAT compliance. So whether it's an internal cost of language capabilities and in IT alignment with the various tax authorities, or the cost of using companies such as ourselves to take the compliance process on behalf of the business. You need to factor it in alongside the staples in your cash flow, like web hosting, accountancy fees, and so on. And preparation and planning is vital part of the journey. However, many businesses who have already made the leap to international expansion find that the cost of compliance is far outweighed by the increased sales and profits. So really, can you afford not to sell overseas? So we help businesses, e-commerce businesses, with their international registrations, returns, and any consultancy that they may need. And we've partnered with the Department of International Trade in order to help answer any questions that you may have to enable businesses to expand overseas. So just make sure that the businesses you're working with don't drown under their international VAT obligations. Another thing that we've made available is we partnered with the Institute of Export to give bite-sized chunks, which you can get CPD credits for, and these can be purchased on the Institute of Export website. And you can also contact us through email, phone, or follow us for any updated rules and regulations so you can keep the businesses you work with on top of the VAT obligations. And that's everything for me today. Thank you so much.
Okay, does anyone on the line have any questions? No, if no one has any questions, then we will formally end the webinar. Thank you very much.
Thank you.